Let's look at this scenario for spousal RRSP. Let's assume that Uzma and Abid are both married and they have RSPs. So Uzma income is more, her income is $120,000 a year. Abid's income is $30,000 a year. So usually the higher earning spouse will contribute to the spousal RSP of the lower income spouse. So let's assume in 2015, Uzma contributed 10,000 to Abid's plan. In 2016, she also contributed 10,000 and 2017 also. So there are $30,000 in the spousal RSP plan for Abid. So in 2018, they decide to take out the money for some unexpected expenses. Now, who will pay taxes on this 23,000? Will it be Abid at the lower tax rate, or is it going to be Uzma at the higher tax rate? So the rule is that the money that you take out, the contributions must remain in the plan for a year of deposit plus 2 years or more for the withdrawal to be taxed in the lower marginal tax rate spouse. So the government will say, okay, this 23,000 is actually coming from this 10,000 and this 10,000. So these two 20,000, this one has not been in for the year of deposit in 2 years. So it's going to be tax will be paid by Uzma. And this one also has not been in for the year of deposit plus 2 years. So 20,000 Uzma has to pay taxes on $20,000. Now, there's also $3,000. So that $3,000 tax on that would be payable by Abid because this 10,000 has been in for the year of deposit plus 2 years, and then they're taking it out. So this is going to be taxed at the lower tax rate. So as you can see, it doesn't really help a lot for them to put into the contribution into spousal RSP plan if they plan to take it out in the near future within 3 years or so. If they had waited or even later than this years, then let's suppose in 2021 they want to take out the balance 7,000. Now this 7,000 is going to be taxes payable by Abid because this has remained in for more than the year of deposit plus the additional years is more than 2 years. So it is always advisable the higher earner is going to contribute to the lower earner spousal RSP. And the benefit of that is that after 3, 4, 5 years, more than 3 years, they should be planning then to start to take it out. And then when they take it out, the lower tax bracket person will pay taxes on it. The other benefit of RSP is it reduces the tax deductions at source. So the year when you put money into RSP, you are going to get a refund in that year. So if you're waiting to claim tax deductions to get the refund, what you're doing is you're giving the government interest-free loan with your hard-earned money. So to avoid it, contribute via payroll deduction to a group plan, and the necessary adjustments to the tax deducted will be made at source. So it's good to have automatic withdrawal from your account for that purpose. So you can make an in-kind contribution to your RSP, and RSPs are not limited to cash contributions. So you can transfer bonds, mutual funds, or stocks in from your non-registered account to your RSP also. So in-kind contribution means you do not sell the shares. So suppose you have $10,000 of stock, which is in a non-registered account. You can transfer that stock directly into your RSP or TFSA RSP, and that is called the in-kind transfer. And with that, it is still considered to be taxable. The growth is going to be taxable, If the shares have gone up in value, you have to pay taxes on it. So that is the way you are able to do that. The benefit is you do not have to pay commission on selling and then buying again. And if the investment values have gone down, you can't claim a capital loss for in-kind contribution. So in that case, it's better to sell the stocks and then you can contribute the money and claim the capital loss. The sixth benefit of RSPs is that you can use the over contribution limit also. There's a one-time over contribution limit of $2,000. This is a buffer in case you make a calculation mistake and you go over the limit. This takes advantage of the tax deferred growth and compounding impact. So if you use that, you can put an extra $2,000 into your RSP, and that is a benefit. Then when closer to retirement, you can claim $2,000 as part of your contribution to avoid double taxation. If you go over that limit, then there's a 1% penalty per month or 12% per year until you withdraw the excess. So now we'll talk about contributions to an RSP. So earned income is what you use to calculate how much you can contribute to an RSP. Most people just have employment income, less any union or professional dues. So the earned income is going to be very beneficial for calculating. Easy way, just be calculated at 18% of the income. But there's other income also. If you have a rental property, the net rental income and net income from self-employment, that also is considered earned income. So that also RSP can be contributed based on that also. Then the royalties from published work or invention and research grants. This also is considered a taxable, that is also taxable and is considered as earned income. Alimony or maintenance payments. If you're getting alimony or you're getting maintenance payments, that is considered as earned income also. And that can be used also for calculating RSP. Disability payments from CPP or QPP, Canada Pension Plan. If you're getting disability payments from them, that also is added. Then supplementary employment insurance benefits like top-up payments made by the employer for somebody who's unable to work, for example, due to parental leave or adoption leave. If the company is adding extra to your payment, so that is called supplemental employment insurance, and that is also considered as earned income. So as you can see, these all factors may result in a higher RSP contribution. Obviously, you'll be cleaning this income in your taxes, and then based on that, your RSP will be calculated. If you go over the limit, then there's a penalty, as we mentioned, and so there is a buffer of $2,000 which is allowed. So deemed disposition means that if you immigrate out of Canada or if a person dies, it's considered as if they've sold their RSP at fair market value. So then there's a deemed disposition if you move outside of Canada. And so you are going to have that also situation there. Contribution in kind, as we just mentioned, you can contribute into the RSP directly using your using the current your stocks that you have in non-registered account. And so that is possible. If you have capital gain, you have to report it and pay the taxes. There's capital loss, you cannot claim it. So it's better to cash the investment and then contribute the money in that case. Let's look at how to calculate the RSP contribution room. There are 4 steps. You add up all the earned income of the last year times 18%. So that is the first step up to the RSP limit. The RSP limit varies every year. And so whichever is lower, you would calculate based on that. So then you minus the PA or pension adjustment of the last year. Pension adjustment will be on your T4 slip, and it means that if you have a pension plan with the company, then you will have a pension adjustment, and that will reduce your contribution limit for the RSP. Then you can add the unused carry forward room from the previous years. And then over contribution room, you can add 2,000 to that also. So let's take a look at an example. Amy earned income of $95,000 last year. Her pension adjustment was $5,400 due to contributions to the defined benefit plan at work. Amy also has unused RSP contribution room from last year of $3,600. What is the maximum amount she can deposit to her RSP? So you can pause and you can work on this and then see the answer. So the way to do it is $95,000 times 18%, and that comes out to be 17,100. Then, like we said, this is the first step, 18% of the earned income minus the PA. So the PA is 5,400, so you minus that, and you end up with 11,700. And then you need to add the carry forward room from the previous year. So 11,700 plus 3,600 gives you 15,300. So usually you would stop there. Usually that is the answer, 15,300. But in some situations, you may need to add also the 2,000. If you want to do that, then the answer would be 17,300, but that's not there. So we're going to select this as the correct answer. So when a person dies, it is considered as if all the property within the RSP has been sold at fair market value. So it is fully taxable on death because this person, whatever money they put into RSP, they earn that money and they never paid taxes on it. So on death, it will be taxed because if they were alive, they would have gone to a RIF account and they would have paid taxes on the withdrawal. Or it can be paid to any named beneficiary, usually spouse. And if it is a spouse, it can be a tax-free rollover. So there's no taxes. It can be transferred to the spouse. They can open up an RSP and the money can transfer to the spouse's RSP without any tax implications. Or it could go to a minor child also. And it can be a registered account, and then it must be annuitized or converted into an annuity by the 19th birthday of the minor child. Or it can go to a disabled child at any age to their RSP. There's no annuitization required. You can roll over the whole amount to a child. And receivers, it as a rollover into RSP. Or this disabled child, they may have an RDSP and they can transfer up to $200,000 to an RDSP. So summary of RSPs, so two types of RSP. There's single vendor and there's self-directed. Under the single vendor plans, they can be invested in different types of GICs, segregated funds, pooled funds, mutual funds. They're held in trust in particular issuer or financial institution. In the self-directed plans, you can invest in funds or other permitted assets like equities, bonds, money market instruments, and they are administered by financial services companies. And there are many other options they can do in the self-directed plans. So the advantages we mentioned already, you can reduce your taxable income directly right away. You can shelter the income with it. There's no taxes on the growth. Tax-free compounding is there. You can defer the income taxes until later years. And there's an opportunity to split the retirement income. Disadvantages are that you cannot get the benefit of tax advantages of dividends and capital gains. Capital gains, as you recall, 50% is taxable if it is in a non-registered account, but in the RSP, 100% is taxed. Same thing for dividends. There was a dividend tax credit. Here, if you have stocks in an RSP and you get dividends, you do not get any tax benefits of getting that dividend within the RSP. When you take out the money, you will pay taxes 100% on it. And it is tax on death. People don't know when they will die. If they put money into RSP and they die, it will be taxed at their marginal tax rate. And you cannot use RSP assets as a loan. You cannot take your RSP and get a loan from the bank based on RSP money. So once the person wants to draw money from the RSP, it is converted to a RIF account. This can be done at any age from age 55 onwards. At age 71, they must have shifted it into a RIF account. So this is a tax sheltered plan available to the RSP holders. So the plan holders transfer the RSP funds into a RIF anytime before they turn 71. The key thing about the RIF is that there is a minimum withdrawal amount annually. They have to take out that money, but there's no maximum. The minimum withdrawal amount may be calculated using their younger spouse's age, and as the money is withdrawn from this plan, it will be taxed as earned income, regardless of the source. So no contributions are allowed into a RIF. You cannot contribute into a RIF, you can only take money out. Then there's locked-in retirement account. So if an employee leaves the employment before being eligible to receive the retirement pension, they may transfer it to a special RSP called a locked-in retirement account. So keep that in mind. This money only is from pension funds. So from pension, it can go to LIRA account. So from pension, it goes to LIRA account, and then from LIRA account, it goes to a LIF. Usually you stay with the company and you retire, you get the money from the pension plan, that's fine. But if you leave the company or you're terminated, your pension, you will get a statement from the company saying you have so much money in the pension account, and that will be transferred to the LIRA account. And from the LIRA, then you can transfer it to a LIF account or a life annuity. And this must be done again before age 71. So the LIF account is very similar to the RIF account, except remember in the RIF account, you had a minimum amount you have to take out, but there was no maximum. In the LIF account, there is a minimum amount you have to take out every year, and there's a maximum amount also. So you cannot exceed that amount. So it is like a pension. You cannot take out your full money all at once. And any money taken out, it is going to be taxed. Okay, next we talk about TFSA or tax-free savings accounts. These were introduced in 2009, and you must be 18 to contribute to TFSA. It varied. It was 5,000, then 5,500, it went up to 10,000. So it varies. And if you have not contributed money into TFSA, your room is carried forward. Qualified investments are similar to other registered accounts in the TFSA. So investments grow tax-free, and if you over-contribute, again, same as RSP, there's a 1% penalty per month or 12% per year. Withdrawals you take out, whether it's your money or the growth, it is tax-free. There's no deduction for deposits, and if you withdraw from the TFSA, you cannot redeposit till the next year. So if you put in 5,000 and your room was 5,000 and you take out 5,000, you cannot put that back in until the next year. And then you can also put in the amount for the next year. So just a summary about the types of investment contracts. We said accumulation. If you're saving money, you can save money in RSP or a spousal RSP. LIRA account or locked in, this is also money coming from pension plans. And if you want to take money out, then you have a RIF or you have a LIF. So from RSP and spousal RSP, the money has to go to a RIF account. And from the LIRA, the locked in, this is coming from pension plan, that has to go to a LIF account. And accumulation and withdrawals, you have TFSA and non-registered here. You can put money in and you can take it out also. It's not locked in. And then you have life annuity also. So on maturity, your RSP money can go to a RIF account or it could go to life annuity. Same thing with the LIRA and the locked-in account. They can either go to a LIF account or they can go to life annuity. The life annuity is something where all these can be converted into. So next we talk about RESP. It is a tax-deferred savings plan. This is intended to pay for the post-secondary education of the child. The maximum contribution is $50,000 per beneficiary, and the Canada Education Savings Grant is 20% of contribution. To maximum benefit you can get for the grant is $500 to $600 per beneficiary, and the maximum benefit you can get is $7,200 per beneficiary. So parents can transfer. So if the child does not go to college or university, parents can transfer their contribution to an RRSP up to $50,000. But that again, if they have room in the RRSP, or they can take out the income and it will be taxed plus 20% additional tax. So if the plan is more than 10 years old and the child is older than 21 and they do not go to college or university, the parent can take out the principal which was contributed anytime. There's no taxes on that. And so this way, same way as RSPs, it is tax sheltering the earnings, but the contributions are not deductible from taxable income. Let's take a look at this chart. It shows you that for all families, when they contribute $2,500 in a year, 20% of $2,500 is $500. They will get a grant from the government of $500. Then based on their income, if they're earning below or up to 47,000, then from this contribution on the first 500, 20% of that is $100 extra. So 500 plus 100, that family will get $600. If the income is more than 47,000 and less than this amount, 500, 10% of 500 is $50. So 500 plus $50, they will get $550. If the income is more than 95,259, then they will just get this $500 only. So next we will talk about Chapter 7, types of investment products and how they're traded. Hopefully you're more clear about this chapter in terms of the taxation aspect.